Here, and you all are here for our webinar called I Need a Better Facility for My School, Now What? And now what? My name is Stuart Ellis. I'm the CEO and founder of Charter School Capital and American Education Properties, and I'm on today with the CEO and founder of American Charter Development, Mike Morley. Mike, welcome.
Hey, thanks. It's always good to be with you, and we're anxious to visit about new facilities for schools, which always seems to be a major issue that many schools face as they get started and expand. So look forward to it.
Mike and his organization have developed, built, and expanded more than 60 charter schools in the country over the last, Mike, more than a decade now. Is that right?
Yeah. Yes.
And
we've been in.
Go ahead.
No, I'm just saying we've been in since probably the early 2000s, and started out just kind of as a onesie-twosie thing, and then saw the need nationwide, and have grown from there. And it's been a real rewarding opportunity for myself and our group, which consists primarily of my 8 sons and one son-in-law. And then expand from there. We're a large family group, and so hope that doesn't scare you away. But we really enjoy helping facilitate good buildings for schools that are starting up and expanding across the country, and find great satisfaction in doing that.
And Charter School Capital has now been serving schools for a decade. We funded our first charter school in December of 2007 in California. The company formed back in 2006. Today, we've funded more than 550 charter schools across the country, supporting over 650,000 students, and invested over $1.5 billion into those schools very successfully and happily. We view ourselves as a long-term partner to charter schools and a strong advocate for the charter school movement. And one of the best partners we've come across, and one who we've built our facilities and real estate services around, is American Charter Development and Mike and his team. And although his team may be mostly family members, I have fewer children and they're younger, so I've been forced to meet friends and find quality associates like Mike to serve the schools with us.
Well, so, you guys are a fine organization.
Well, that said, the 2 pictures of us that everybody is looking at are probably from a decade ago.
Yeah, but right. We still look the same, right?
Yeah, we look great. So you look great. So today we're going to cover our perspectives on the market and the impact that changes in the capital markets may be having on charter school funding opportunities. The tension between balancing your facility's dreams with the budget realities of creating the perfect facility for your school. Understanding and choosing a funding structure and that works to fund the program and the building or facility you want to have. Getting funding approval from any potential investor or capital support. Some details about project execution and timing, and other considerations we have. Throughout the discussion today, feel free to send in questions or comments as we go, and to the extent we haven't addressed those directly with the flow of the materials or with the conversation and dialogue Mike and I will be having, we'll add those in and we'll address them as we do flow through things. The material, you don't need to screenshot the material or anything like that. It is available after the webinar today at charterschoolcapital.org/webinars, as you can see from the bottom of this page. There you will not only see the presentation materials, but you'll also have access to a recording of the webinar itself if you'd like to share that or the materials with anybody else. People can come, link to that, and download all the materials and information going forward, and it stays there. That said, let's move into the material itself. So, high-level comments on the market. Today, the National Alliance of Public Charter Schools reports that facilities remains the most significant obstacle to the growth of charter schools in the country. Even with 3 million charter schools now, or charter school students served nationally, actually the Alliance recently expanded their quantification of students on waiting lists from this report, which says 1 million. Nina Reese, the head of the Alliance, actually reported in recent weeks that there are now 2 million students on waiting lists for charter schools, which gives you an idea of the constraints associated with just the number of seats available at the 7,000 charter schools that now exist. That said, there are more financing options available for charters than ever before to support expanded enrollment, but not all schools are able to or have been taking advantage of these things. And if you look at the market, money is certainly cheaper than it was a decade ago or even 5 years ago. But with the change in the federal government and the new president and new Department of Education, some disruptions in the capital markets and inconsistencies and unpredictability, rates have actually been rising over the last 6 to 12 months and are expected to rise significantly in the next year or so. The Fed is looking at raising rates, and that passes through to all aspects and participants in the capital markets. So there are opportunities to refinance your current properties right now that should be considered regardless of whether you're expanding. There may be an opportunity to either lock in a fixed rate or at least predictable rates for the long term, and that may be something you can consider.
Yeah, we've seen that too, Stuart. We've seen that a lot recently as we've worked to help schools secure financing. You know, it's incremental, but it's definitely on the rise. And so it is a time to really consider the future and consider what your future is. You know, if you're locked into a good long-term bond, or you're fortunate to be in a good lease situation, then good, that's a wonderful thing. But if you're tied to a variable rate type vehicle, then it's probably time to take a look at that, because that's going to climb.
I agree. That said, let's talk about the different funding challenges and when schools are thinking of facilities. So one of the things to consider is, on the one hand, everybody asks, well, how much can I afford? And that needs to be balanced against what's required. And although it's on the right side of this chart, I think the first thing to think about is what is required to support your academic mission, to think about what your growth plans are overall for enrollment and attendance in the relatively near or medium-term future. Are there any specialty requirements? Are you running a program that is a dropout recovery group, or something that targets special needs kids or autistic children or students? Whatever those programs
or even
are,
athletics.
Yeah, athletic programs.
Or even athletics, or performing arts, or a number of other kinds of schools that we've seen be very successful. But obviously, an athletics program without a basketball court or without some kind of a field is at a real detriment. And the same is true with the performing arts without any place to perform. So those are certainly issues that need to be taken into consideration.
Also, local considerations around the geography or specific location of your property. There may be very different laws associated with or zoning requirements in one area versus another. There may be different tax implications, which affects the structure that you'd like to go after. And even just weather patterns in a particular locale may completely differentiate one type of building that you may have versus another. So obviously, if you're just a school building or going to have one school and that's the entire extent of your network, that the weather change isn't as significant moving 2 miles away. But picking what county you're in may still differentiate and the other local considerations matter for larger networks that are expanding across the country.
We actually spend a great deal of time on this planning in the beginning with any school. It really has a significant impact on what they're doing, and you find that what constrains one school may not constrain another. When you go into LA or you go into Denver, or you go into some of these areas where there's high growth and property costs are very high, it's hard sometimes to find facilities that match the budgets that the schools are receiving. And it's really interesting, that most states fund on a per pupil basis, and those funding formulas don't change based on the economics of the area or the high growth or the cost of property or even the cost of construction. So, it makes some of the high growth, very elite areas very difficult to afford on the budget that the state or federal government, whatever the case may be, however the funding structure might be, provides. And so we really have to get in, and I think schools are wise to look very carefully at what their needs are, what the costs are in the community, and balance those needs. In some cases, it's not possible, but we try to pride ourselves in being able to find the possibilities and make it work. But it's not always easy. Now, in some parts of the country, you might find very inexpensive land and low building costs and higher opportunities for reimbursement. So it works financially very easily. In other parts, you have to be pretty sharp and do a pretty darn good job in balancing those needs against all of the other needs, because usually in some of those areas, costs for teachers and for other required expenses that go into the overall budget are high as well. And so it's we understand. I think Stuart and I have talked about that often, that different schools are in different environments and have different needs. And so anytime you can get some good expertise to help you navigate those waters, I think you're far better off, especially up front.
When you think about to Mike's point about what you can afford, considering what the school's existing reserves are, the ongoing percent of revenue that you want to commit to your facilities, which takes away from money you can spend on teachers or the academic program, the additional fundraising that could be added to your reserves, whether it be from public subsidies or grants or private foundations that may donate money to the school, and then looking at the different structural funding alternatives, which we're going to get into in a minute, are all considerations. But the ongoing percent of revenue is something that you make a choice about. Some of it is around the actual costs, and some of it is around the what choice you make strategically. On page 9, this chart, how much we can afford, lays out some ideas or some simplistic ways of thinking ballpark around what you can afford to spend on your facilities as you plan. And what you see here is on the left side, or the vertical axis, you can see the potential project budget or the cost of land and building, how much you can spend, and that rises from 0 up to, in this example, $20 million. The x-axis going across the bottom is the school's ongoing annual revenues or projected revenues that you might expect. And then the 3 lines, the gold line, the gray line, and the green line, are at 10, 15, and 20% of your ongoing revenues. Now, this assumes an average, not a best-in-class cost of funds. It includes the average cost of funds for a school that you may have to pay or contribute on an ongoing basis, whether it's to a bond or a long-term lease or some structured financing that involves approximately 100% financing for the project. But with that in mind, we've basically used it as a way to simplistically ballpark how much you can afford. And what you see here is, if you go out to moving along the horizontal axis to where it says $6 million, If the school was to spend 10% of your ongoing annual revenues, or about $600,000 a year, on your facilities, you could actually afford a $6 million building or project if you were going to spend 10% of revenues. If you were willing to spend 20% of revenues on facilities, you could afford a $12 million project or building. Now, the realities of what you need to support the exact design and execution given your market will change. So the cost of land and construction in California, for instance, is very expensive relative to the cost of doing the same in Ohio or Michigan. That said, another challenge in California is that the revenues per student are relatively low. They're similar to states like Arizona or Florida in terms of total dollars per student, but the cost of the real estate is much higher in California. As a result, most schools in California are running at or around much closer to the 20% facilities cost to revenue level, whereas schools in Ohio or Michigan are commonly much lower, more in the 10% range. Now, that could vary based on the local market, as I just described, revenue per student and the cost of the real estate execution. It can also vary depending on your strategy. So you can allocate a lot more to facilities to create an attractive or supportive environment. As Mike indicated, if you have an athletics program, having a great athletics facility is very important. If you don't really need that. If you're offering an arts program, having an excellent sound dynamics room for music, or a concert hall, or a black box drama theater, or something like that are all really great things to have that may be worth spending money on. Those are all things you have to think about and consider. One thing as we get into the underwriting that you'll hear is there are very few investors anywhere who think it's sustainable long term to be above the 20% rent or 20% debt service to revenue level. That begins to get too high, and from a competitive standpoint, it's not that you can't afford the program, it's that you're not spending enough on the program and instructional aspects overall. As such, likely over time, other charter schools or school districts or private programs will be more effective at delivering quality education than you will, and your program won't be sustainable, which is why when we look across our 550 schools, we consider that a limit, and why most financial institutions won't fund you long term at above that. That doesn't mean in your first year you can't be above that, but if it looks like that's where you're going to be long term, it is less likely to be sustainable. Mike, other thoughts on this?
I think you've nailed it pretty well, Stuart. I think that it is important to have an attractive facility. It helps draw. I mean, really, the issue with charter schools, particularly starting up, is all about enrollment. Enrollment drives it drives everything. It drives budget. It drives the school. And to maintain enrollment, you have to continue to deliver a great educational product. To get enrollment, oftentimes it requires that you have a nice facility, or at least an attractive, safe facility that parents are comfortable leaving their children at. And for all the reasons that Stuart has mentioned, balancing those needs is a very critical thing in the marketplace.
So before we move to the next concept, we're going to transition to talking about the structure of different alternatives that are available to schools depending on your size and maturity, et cetera. Before we do that, we'd like to ask the opinions and poll people out there on the webinar today, the participants. We're going to take a moment. We'll just pause for a minute and give you a moment to answer a few questions that we have, and then we're going to transition to this chart on page 10 regarding the alternative capital sources available for schools. So with that, I think you all can still hear me, but you won't be able to see any of the materials. That said, please take a minute right now, and if you wouldn't mind filling out the poll that'd be great. And then Mike and I will drop back into the structure. By the way, I really appreciate the response we're getting. More than half the participants of you guys out there have already taken the poll. I think we've never done this before, and so for us it's new, and we appreciate getting your feedback right here.
Yeah,
so,
the feedback that's very helpful to get timely feedback in a webinar. That's great.
Yeah. So with that, I think we thank everybody who just participated in the poll. That was great. And we're going to continue through the materials. Are things back on over there, Mike? Can you see the
yes
chart on page 10?
That's Foursquare.
Yeah. Thank you, everybody, for your participation. These are the options. The way we've tried to simplify what the different options available to charter schools. Just as the previous page said, how much can I afford? This is, and what are my alternatives? The way to look at this is, again, if you look at the vertical axis, you can see going from small to large as a school in terms of dollars or the size of the deal or financing that could be out there, which it equates to the project size on the previous page. What's the size of the financing you are looking for in the market in terms of total dollars? And on the horizontal axis, how long has your school been in operation? And the midpoint that we've noted here in terms of a real inflection point for schools are when the deal in the market is more than $10 million. And depending on which bond broker or financing source you're dealing with, could really be as low as like 7 to 10, but somewhere in that range. And most shops don't really want to deal with transactions that are less than 10 million. It's not that there aren't people out there who aren't willing, it's that there are significantly fewer options available for a deal that's less than 10 million. We'll talk about why in a minute. And then number of years in operation is less about the number of years and more about that note you see at the top of the chart, which says first renewed charter. So if you are in your first period of the charter program and your authorizer or local market has not confirmed your success by renewing your charter and extending it another 5 years or 15 years or whatever it is in your local state, then there are still question marks for investors to think about, and you're viewed as a more risky funding potential investment. And at less than 7 to 10 million, you're also a very small transaction. So if you are a financial investor or participant who has to do a lot of diligence on a school or a program and work associated with the transaction, maybe the transaction takes a year, most bond brokers or financial investment brokers are charging about 2% of the transaction. So if you think about it, if it's a $5 million deal, they're only getting $100 grand to do the work. And while that may seem like a lot to executive directors who might not be making $100 grand to run a school, for an investment banker or broker, $100,000 to work 6 to 12 months on a transaction is not very much money. It takes a lot of time, and they would rather do the same amount of work on a $50 million transaction and get $1 million bucks. So similarly, the diligence required for an investor is quite heavy, and just putting in, $1 million or what have you is something that people are not that excited about doing if they have to do all that work. So with that said, the options, if you look at these different quadrants, less than 7 to 10 million and prior to your first charter renewal, the options typically available to charter schools are going to be, these are early stage schools, are short-term lease. Most schools start out, leasing office space or in the basement of a church or taking over some empty school, or in California might be with Prop 39, or other states have programs where the local school district has to grant access to a local charter school for a mothballed or, old school that's not being used. And so you get into short-term leases. The risk, of course, associated with that is at the end of year 2 or something like that, the landlord comes and says, and doubles your rent, or wants to kick you out to have somebody else come in there, or the authorizer or local school district says, hey, we're going to reopen the school, and you have to move. And if you have to move far away or you can't get another lease, then your school's at risk. Today, there are also long-term lease options available to schools that didn't exist previously. So organizations like American Charter Development, Charter School Capital, and other players out there are now offering 20 to 40-year leases to schools, even those prior to their first charter renewal, for schools that look like they're sustainable, where you can then have the control over your facility and be sustainable without having your rates or rent kicked up, exponentially down the road, or having you threaten to get kicked out of your lease. And so that's a great option. And then the last option available here are developers, organizations like American Charter Development, who will get in and do ground-up development or completely renovate a building for a school, even a school that hasn't opened yet, if the management team has a great track record or if the expansion program for a CMO or EMO. So those options are available to early-stage schools. If you're larger, the long-term lease and developer options are even more viable. So it's still hard if you're a $2 million transaction or $1 million school program to get access to all these things. They are available. But as you get bigger, if you're a $20 million program, everything about the efficiencies and scale to all the participants are better. So you end up with more options there. Once you go to...
it is true.
Go ahead, Mike.
I was just going to kind of echo what you said and reinforce that the biggest challenge and hurdle to startup schools are facilities. They just are, and that's what kind of caused us to get into this facilities market. We've been in construction and facilities development for over 35 years, and as we watched charter schools begin to develop through different states and recognize that they're constrained for capital and development up front, but have the ability, if properly managed, to pay for facilities through their reimbursement and through again enrollment and having students to teach, because basically a charter is just a contract with the state to educate children. We realized that there needed to be a better way, because warehouses and old shopping centers and dilapidated storefronts are not great places to educate kids and really do constrain the environment, the teaching environment, and the safety of the students. And so we really do think that for new startup schools, that really the only option is either a short-term lease in a less desirable location, unless you're very fortunate to find something that is available that meets the needs, or a developer deal where someone is willing to take the risk to bring a nice facility online for a school to open and stabilize. And typically those are 20-year lease deals with some purchase options potentially if the school wants to have that opportunity to purchase their facilities. But again, it is not likely that any bond company is going to take a risk on a startup school. It's not likely that any capital funds are going to take a risk on a startup school without a developer or without some guarantees. It's interesting that charter schools are typically, and not in every case, but most states require that they're a 501c3 nonprofit organization that can't provide any guarantees and don't have any large capital reserves, at least starting out. And so to expect to find a landlord that's going to want to put millions of dollars in tenant improvement into a facility to take a risk on a tenant that cannot provide a personal guarantee and has no no operational history or no financial statement is really an anomaly in the marketplace. In fact, I don't know of any other real estate transaction where that would even be possible. But because charter schools have been successful in many cases and have a good track record of performance in most states, if the team is strong, if the boards have experience, then there are groups that are willing to take that risk and provide those facilities, and at a reasonable price, considering what it costs to go out and obtain capital for a venture as risky as a new startup business. So I think Stuart, I think the graph here is very accurate and is something that is worth consideration, particularly if you are just expanding to your second or third school or starting your first school.
I think that you mentioned also the risk somebody is or isn't willing to take. If you look at the right side, the two quadrants on the right, around once you get to that kind of first year renewal, different options open up, and the more conservative players in the capital markets then begin to participate. So the bond market, most schools think I need to own, and when I get out here, I also the dream is I get a bond. The people who think that generally have not done a bond. If you've done a bond, you don't think a bond is a dream. But one of the dreams of a bond is that if you really are done expanding and building, and you're in your dream facility and the place you want to stay forever and stay forever at that size without additional expansion or investment needed, then a bond is a great tool because it's typically 30-year paper or 30-year amortizing principal. And if structured properly and you are beyond your first charter renewal and you have long-term access to things and the program looks sustainable and strong with all the kids in it, the rates you can get can be quite attractive. And if the transaction is large, if you're doing a $20 million plus transaction, then the typically very high legal expense and brokerage fees and transaction costs associated with the transaction, which can run in the millions of dollars, those things get spread over a large transaction and many years. Where a bond tends not to work is if you are really much smaller transaction, which is why both the bond brokers and the schools typically don't want to do deals at under 10 million, or if you're going to be expanding or effectively refinancing it later because you have to refinance it. But that said, if you're big, if the deal is big and you're past 1-year renewal, the bond market is definitely an option for schools here, and it can be a great option, albeit it typically takes longer and has some high transaction costs. The other options that become available out here are banks. Now, banks typically, when they're funding a school directly, are going to require some level of equity or reserves. So you're going to have to contribute typically about 1/3 of the transaction, but anywhere from 20 to 40% of the transaction will be required for a bank to provide the rest. That money is also relatively inexpensive. However, and the transaction costs are typically lower for a bank than it is to do a bond. However, you do actually have to come up with 20 to 40% of the money in cash. And then finally, just like the earlier stages and or smaller transactions, today long-term leases are available, which have become a fairly efficient product, which has costs similar to the bond and offering 100% financing, which is different from the bank. The long-term lease programs offer a school control over its property, with somebody else being the real estate investor and technically owning it, although you have control and access to it for that entire period. And I think it's important.
Now, let's talk about that.
It's important to differentiate.
Let's talk about that,
control
Stuart.
and ownership. Go ahead, Mike.
Because I mean, I was just going to say, we do and have done credit tenant facilities for a number of national firms who don't own their real estate ever. And you may expect that they would as you attend or go into their stores constantly, and they're all over the country. But rather than choose to own their facilities, they focus on their core business, and those and leave the real estate headaches to those who are leasing to them. So, it's not a bad strategy to have a long-term lease that allows you to operate your facilities over a period of time. And as demographics change in different areas, I mean, we see all the time areas where schools were very prominent and did very well, and after 20, 30 years, the environment changes. It kind of becomes more of a retirement area. Those schools have been closed down, and new schools are being built in the suburbs. And so, sometimes and again, it depends on your view of things, and it depends on how an operator may feel, but it's not unreasonable to think about leasing long-term and negotiating the best terms that you can, recognizing that you're not stuck with a building in a dilapidated state that needs a considerable remodel after 20 years to bring it back up and to get it refurbished and looking good and competing with others, and potentially being in an area that then may not be the prime area for your student base. So there's just a lot of considerations there, and long-term leases shouldn't be discounted summarily just because a school feels a desire to own the real estate. As long as they have a secure lease that allows them to plan into the future for their educational models and to fulfill those models, that's a good viable opportunity or possibility for them.
Two things to say as we look at some of the options or some of the considerations in thinking about a financing structure is a lease is just another form of financing, really. What schools think about or should be thinking about is how much am I spending each year to actually be able to run my educational program? How much am I spending on facilities? Whether you call it debt service or interest in principal or rent or lease payments, doesn't really matter. It's how much you're paying each year. The ownership of the real estate, the rise and fall of the real estate market, the underlying value of the land, the depreciation of the buildings, et cetera, those are investment decisions. And a lot of people on the boards of charters or who are running charters, we're collectively more unsophisticated finance people. And what I mean by that is our experience with financing real estate is we financed our own residents, right? We went out, a bank gave us 80 to 90% advance rate, on our house. We bought our house, boom, we have the American dream. And everybody's thinking that's the only way I can control my outcome. Without commenting on whether or not it's a good deal to finance your own home as opposed to, if you could get a 30-year lease on it, which is not very common, by the way. In the charter school space, it's not needed. And when you're looking at the business, the real estate investment, the reason people want to invest in real estate is often lost on some of the schools. And that is that there are huge tax advantages to for-profit investment groups, which create shelters associated with the way the tax code is written for real estate. As while not evidenced by our current president, certainly something that the current president is famed for having taken advantage of. The real estate creates a bunch of potential investment returns, but one of the primary ones is tax benefit. 501c3s don't get to take advantage of any of those tax benefits. As a result, one significant benefit of the transaction somewhere in the capital markets is not actually being utilized when you execute as a 501c3 a bond market transaction or loan. a recent study conducted by the California Charter School Association and the Colorado Association determined that the most efficient form of financing or structure for funding facilities in the country today for charter schools is the long-term lease. We've actually requested a copy of it. It was just completed, but Michelle Lynch of the California Charter School Association just informed us of that study at a seminar that Mike and I just did with Michelle. And it's interesting because it's something that we've been encouraging schools to pursue for years because of the efficiency. That said, you still effectuate the most important thing for the school, which is to control your property long term. And when you look at other businesses, I always think it's interesting. Walmart as an organization is a retail store, retail chain, which I think most people would view as very sophisticated. They do not own any of their properties. None of their stores are owned, actually. In fact, after many years of doing it, Walmart recently formed a separate entity, which is a Walmart Real Estate Investment Trust, where they're getting the tax benefits separately. There's a separate company that decides which, like Walmarts they want to own, and then they go and they fund some of those for ownership. But Walmart itself, the retail operation, just literally leases its space from other landlords and or entities in strip malls. That opportunity is available to schools today. Maybe more than 5 years ago, that wasn't commonly available, but today it is. And as you think about, and then Mike, we'll turn back over to you and we can touch on the different structures. Things schools need to consider are just evaluating the total dollars, not the teaser rates advertised, in interest, but interest rates advertised, which is a language of a loan, but just looking at the total dollars you'll spend upfront and annually to get the facility you need. The other thing to think about is cost is not just money. The time and opportunity cost associated with your management team, particularly a busy team educating kids, going out and running around doing the bond market show, to raise money from different investors, can take a long time and a heavy burden on management. And some transactions can take 6 to 12 months, whereas others, long-term leases or programs like that, may take 60 to 90 days. And then thinking about the constraints and impact of future options is something that you need to think about also. And Mike and I will now talk about what the different trade-offs are for some of those options. Mike, you want to touch on, I'll provide an overview of this page, and then you can kind of talk about your experience with the different pieces on this page 12.
Sure.
So if you look at financing options, we've simplified the market down into 4 core structures. That people are asking questions, and we'll get into them momentarily, about new market tax credits or tax-exempt conduit financing through banks and other things. But for a moment, those are all subsets of these different pieces. So there are kind of 4 different core options that you can think about that are available as a school. One is fund 100% of it with cash you have on hand. And yes, most schools don't have that option. You don't have all the cash on hand. But if you did, that is an option, and it has benefits. On all of these options, we're looking at 6 components down the left-hand side of this table. The cash needed to close the initial transaction, your annual ongoing cost to fund the facilities, underwriting or the approval required, the security interest or collateral you have to post in order to get this funding, what your growth options are or constraints in the future, and other considerations or challenges associated with these specific options. The other 3 options are bank financing, which the primary difference is you're not funding 100% of it, right? In the case of cash, you're financing 0. In the case of the bank, you're financing 20 to 40% of the equity or the contribution of the cash to the transaction. You're financing with the bank 60 to 80%. The bond market is, again, 100% transaction or funding, and long-term lease 100% financing. Mike, you want to talk about some of the trade-offs as you think about these different things as you've experienced them?
Yeah, I'd be happy to. In fact, I think it's very important to know that we're not pushing one structure over another, because depending on your specific situation, one may work well where another may not, and you may be in a situation where those different structures may work better for you than, or one may work better than another. For example, cash. If you had cash on hand to be able to do the transaction, it may or may not be in your best interest to do that, because that's not very often an option for most. I won't spend a lot of time on that, but you may be able to deploy your money better in some other way if you did have that kind of cash, and pick up either bank financing or do something other than cash at 100%. Bank financing.
Like Mike, you could hire more teachers.
Exactly. Or you could, there's just other ways to deploy that cash that might be more effective. But bank financing, for example, that's a great option for those that may have the money to put down a 20 or 40% up front. There are there are situations where that works very well, and yet most startup or expanding schools are cash constrained. And being cash constrained means that you can't grow at the rate that you would like to, or be able to educate as many children as you'd like to. And having that much money tied up into your facility keeps you from being able to do exactly what Stuart mentioned earlier: hire teachers or provide opportunities that you would like to provide for your students in order to better produce an academic outcome, or to focus on whatever your core focus might be. And so bank financing, particularly at the beginning, becomes very difficult based on the constraint of the cash up front as well. In a very similar way, bonds are in the same category. The underwriting for bonds becomes very difficult, just like for banks, particularly if you don't have a long-term history. Just as the previous graph showed, if you haven't been around long enough to get several audited financial statements and have a proven track record and been authorized again, so that you've gone through your first renewal and provided a bank or bonds with some surety that you are going to be in business and be able to service that long-term 20 or 30-year commitment, then it's a pretty tough pill to swallow. And in a bond situation, you may not be coming up with a lot of cash up front, but we've seen situations where bonds become very, very cost prohibitive. Even though they may be quoting a 6% rate, by the time you have cash reserves on hand that you're actually financing to keep in the bank for the security of the bondholders of $1 million, and you're paying interest at that same rate over that same amortization on those reserves, and paying hundreds of thousands of dollars in legal fees for attorneys, usually 4 or 5 representing so many parties to the transaction, that the costs in reality are not as they may appear. So got to be careful about that. Again, there's going to be a significant underwriting on bonding, and will require that the school is seasoned and able to do so. And for the same reasons that Stuart articulated on the last page, it's important that you understand that it isn't as cut and dry as it may seem. When you get into long-term lease, at least up front, the long-term lease seems to be the most economical and viable for most schools. Now, many of those transition into a bond transaction or to a bank transaction after a number of years, trying to stabilize the cost. But usually a new school or an expanding school will find that long-term leases will be a more viable way for them to get in. It requires no cash up front typically, or very little. Obviously, the cost of the lease will be driven by the terms of the lease, but can be very affordable. Underwriting can be done without a lot of experience, although boards and curriculum and demographics are looked at in detail, and rightfully so. The security interest, you have basically, a school has really none. There's usually no guarantees on the part of the individuals, and so the school is basically securing it with its good name, with its program, and with the facility itself. It gives opportunities for quick expansion and growth, because most people who are in the business of leasing you property are excited about your success. And so if you're growing, that's an awesome opportunity for them to deploy a little bit more capital to support your growth and help you to become what you want to be. It really becomes a public-private partnership between the two. A private investor is wanting to see that you succeed, and typically will do about anything they can to ensure your success, because they know, like we know, that there is no win-lose in a lease situation. It's either a win-win or a lose-lose, and so we do everything we can, as does Charter School Capital, to ensure the success of a school as it begins to grow and flourish. And so I think that there are transitions from one school may take advantage of all of these different vehicles. There may be opportunities where bank loans will be important to their survival and stability. There might be a time when a lease is converted into a bond, or if you have 2 or 3 or 4 facilities that can be in a pooled bond that allows that to be, as Stuart mentioned earlier, a $50,000 or $60,000 or $1 million transaction, to spread those costs over a larger pool. And there might be opportunity where a school network is able to accrue enough capital that they might consider doing a cash transaction. But typically, with new schools or expanding schools, the lease option and long-term leases can be very effective.
Mike,
anything that I missed?
No, I don't think there are things that you missed. There are, I would say, yes and. So a couple things to add. One is, one of the structural issues here, if you look at security interest, is the banks and the bonds will collateralize against both the land building, the hard real estate assets, and all revenues of the school. And all of these options are really funding for the real estate. So one of the questions one of the participants today has asked is about, whether or not the costs include furniture and equipment, so FF&E. The furniture and equipment side of things are not things that real estate investors want to invest in, because desks and chairs tend to walk out of buildings when the financing goes in the toilet. Sometimes toilets also walk out of buildings, but desks and chairs are relatively easy to remove, whereas land and building kind of stay behind, and then the financing source can essentially go back out and sell it to somebody, or refinance it with somebody, or lease it to somebody again. However, in a long-term lease, the only collateral, it says none. One of the reasons for none is the landlord owns the building and the land, and you're just paying rent on it. You bring your own furniture, but your revenues are not locked up under the lease. As a result, you can go get financing for furniture and equipment, which you typically can't do in the bond or bank financing. Now, the bond or bank financing just gives you as much money as the financials show it can afford, and they typically limit it against the value of the property. A lease may be just done against the the land and building, sometimes developers or the financing source that provide that lease will provide you a budget for furniture and equipment, but they really don't want to. The nice thing is that other providers, so Charter School Capital, for instance, provides working capital financing where you could utilize that money for technology, computers, equipment, furniture, buses, or anything else. And that doesn't conflict with a lease at all. In fact, it works in a complementary manner with that, whereas the bond or bank financing, you would actually need to go back to those investors and carve out the ability to get financing for something else elsewhere. So that creates some constraints and flexibility. That the lease offers flexibility, whereas the other financing offers some constraints. I think other than that, we have a few minutes left today, and I'd like to touch on some of the other material. I'm gonna skip through some of this just so you can see what's here, but it is of note that while 12% of charters nationwide have received bond market financing, the other 90% or 88% of the schools are actually getting funded some other way. So if you feel like you're alone out there, that you're the only one not in a bond, just to be clear, while there may be loud, raucous parties associated when the bond brokers do a bond, 9 out of 10 charter schools don't finance themselves that way. We did two example comparisons simplistically that summarize that previous chart, and we've done them for a $5 million project here on page 14 and a $20 million or large project on page 15. What you see here is green implies easy, straightforward, or good relative to the other options. Yellow is kind of somewhere in the middle, and red is not necessarily a no, you can't do it, but it's more costly or more difficult to get done, or really, really prohibitive. So a $5 million school project is easier to do from a cash standpoint, but still it's red because you have to have $5 million. And most schools don't have that. And the growth options later, you have to have the funding yourself, any expansion. So that's hard. The costs, of course, and the approval and the security interest are nothing really easy, right? You just approve yourself. At a bank, there's a little bit more mixed. Smaller transactions tend to be easier for banks to do because it takes up a smaller percentage of their total loan portfolio, and they tend to prefer these smaller transactions. A lot of these are community banks or regional banks who are funding the school directly. Larger banks and larger transactions, the bank will tend to participate either in some other investment vehicle, or they'd rather fund the developer or somebody else, and by extension they're funding the school, but they're not direct funding the school. The bond market, as we discussed, for a small transaction is really just cost prohibitive, and frankly there are very few partners willing to even do something as small as a $5 million deal. And the lease option is very good for, on most fronts, is the best available option for smaller projects. When you flip over to a $20 million project, the 5 boxes you can see are really where things change. So in a bank, the larger transactions tend to be more difficult. There are fewer banks willing to do a $20 million plus transaction than there are willing to do the smaller transaction. It isn't that banks aren't willing. Large national banks certainly are willing to do these kind of things, but it's a much riskier transaction as a percentage of a bank's portfolio, and it's harder to get that. In the bond market, however, a $20 million transaction becomes much more fundable than a $5 million transaction. The annual costs, the large transaction costs, are now spread out over the life of the 30-year paper and a much larger dollar amount. So as a percentage of the overall cost of the transaction, it tends to be smaller. But one of the things noted on the chart we had back on page 12 is that if you think about the transaction costs associated with the bond, one of the issues here is that the transaction costs tend to be about the same anyway. You may be spending $1 to $2 million to do the bond, given the interest reserves and other things. And when it's against $5 million, that's a huge amount. That's, you know, like 40% of the money, or 20 to 40% of the money is going to something other than the land and building they have to pay for. Whereas when you get to a $20 million project, maybe only 5 to 10% of the project is going to stuff other than the land and building. So it becomes much more efficient. Still, the long-term lease at larger values, you tend to get better rates. And one difference between the bond and the lease that people don't really think about or appreciate is in the bond, if you do a $20 million project or financing, maybe $18 million is being spent on your land and building, $2 million on the transaction. But for the $20 million financing, you are both paying the interest on the $20 million and the transaction cost, and you're paying back the $20 million. Even though it's spread over 30 years, you're still paying the $20 million. In a lease, you are paying not the transaction costs, which tend to be very low, more like $100,000 than $1 to $2 million. You may be paying higher rates. However, you're not amortizing the cost of the land and building. The $20 million is only 18 in a lease, not 20, and you never pay back the 18 or 20. You just basically are paying the lease payment. The real estate owner still owns that, and they are doing something around financing and depreciating and amortizing the value of that real estate to other investment benefits that the school doesn't get. In the bond transaction, you own it, so you have to pay for it over time. In the lease, you don't own it, so you never have to pay that cost. As a result, the annual cost of these tend to be competitive for bonds, and now that the long-term lease market is more developed, for leases. I'm going to just note for everybody that it's 11 o'clock Pacific, 2 p.m. Eastern. We're just going to wrap things up now just in a minute or two. I wanted people to note, and in fact, I'm going to show you something here with the contact information for both of us, and I'll come back to these different options because I want Mike to touch on some programs that he and I execute for schools, and I'm going to answer a couple of questions that I think there's one question that we haven't touched on yet. But just for clarity purposes, in here are funding structure requirements, passing the test for underwriting on page 18. These apply to every place you go. Everybody wants to know about stable and increasing enrollment, whether they're a lease or a bond or a bank. Everybody wants to know you're going to be sustainable long term. They do that based on what things look like for your demand in the local market or your waiting list or existing enrollment. They also do it based on the history of the leadership team, the management, or the school itself. If you're the school replicating your 6th or 7th school, that's obviously a great track record. You can look at what the other 5 schools have done. If you're a new management team doing things, it's much harder to get funded by any source. Financially, the numbers have to pencil. You know, you have to show you can sustain the debt service payments or the lease payments and still fund a quality program over time and generate break-even or a surplus sustainably. And finally, governance issues. Everybody will want to talk to your authorizer. Everybody wants to understand that the local authorizer who issues your charter is happy with what you're doing or will want to renew your charter when it comes up or is supportive of the school overall. And so that's here. There are some other specifics in here that we'd recommend for people around planning ahead, the length of time it takes, keeping an eye on rates in the market, and some of the dynamics of working a transaction. There's information in here about some of the details of execution. All I'd say about that is this is like the movie scenes with stuntmen, you know, like professional stuntman, you know, call Mike Morley if you want to do this. Don't try this at home on your own. The design and build out and zoning of a ground-up development is highly complex. There are a lot of risks associated with it. There are very few funding sources will fund you directly as a school to kind of do it with a mishmash of players. They're much more confident in places like American Charter Development or other leading developers in the country who have done this before. Mike and his team have executed more of these in a quality way than really anybody across the country. And choosing a partner, whether it's for the funding and financing itself or the execution or both, like you get with partners like ACD or Charter School Capital, is a really excellent way for you to offload and not really have to think about it, these very complex projects. The financing is complex. The execution of the projects are complex. We are going to touch on a few questions, and I want to let Mike make also a few final comments. but I wanted you to know that we're both available. Our organizations are both available for participants here, and the presentation is, again, available for download, and the recording will be live post the webinar. You'll get an email link, and you can go there. Feel free to forward that to others who didn't have a chance to join us today. But you can get it at charterschoolcapital.org/webinars. My email is there. Mike's email address is here. Feel free to follow up with us and talk to us. This is what we do for a living. We fund, build, and develop and support charter schools getting started, growing, and expanding. And that's what we do. Mike's been doing it for more than 15 years. Our organization's been doing it now for over a decade. And this is what we live for. So with that, Mike, final comments on any of the materials that I just flashed everybody through, approval, or any other thoughts about some of the other funding options?
Let me just start out by saying, hey, for all those that are out there that are getting ready to start a school or in the middle of running schools and are trying to expand, congratulations for the time and effort and all of the tireless or sleepless nights maybe that you've put into this effort. I am very supportive of charter schools, and I'm very supportive of choice in education, and I applaud your efforts as you move down this road. There are a lot of things to consider, and finding good help and finding those that would guide you and give you some expertise, I think, is very important. There are many options. There are a lot of pitfalls that you can get caught up in. We see people that run out and get an architect and start designing and then realize that there is no money available to pay the architect, and then they end up in a situation where they have a lot of bills and really no way to pay it. Just plan ahead, look at where you're at, get the expertise that you need. Certainly, Stuart and I are anxious to help any way we can, and our firms are available, but there are others that have expertise that can provide you with good expertise. Just take advantage of those resources so that you don't make mistakes that are difficult to recover from. And we wish you all the best, and we're available to answer questions at no cost. And so if you have questions, our team is available to guide you and give you direction, even if you choose not to use our services.
One thing I'd say, there were a couple of questions that we didn't touch on. Most of them we touched on as we went through the presentation. We weaved them in. There was one question from one of the participants today was whether we have experience with bank-qualified tax-exempt conduit financing. The answer is yes, both of us do. Both of our organizations participate in programs like that. We're happy to talk offline to your organization if that's something that you're looking into, to provide you some guidance and support there if you need that. There were other questions about identifying charter school board members with backgrounds in the facility space. And again, depending on the local market that you're in, we have organizations have connections all across the country. We're happy to introduce you to local legal counsel or facilities expertise, developers, and successful local players that can help support you as a board member in navigating that process. And again, as Mike mentioned, there's no charge for anything like that. As a nationwide, we actually even provide
some board training opportunities at no charge for boards that may want some additional help and just to give them a background. So, and I know that Charter School Capital, they are a great firm, have been in this a long time and have a wealth of experience in so many areas that reach out to Stuart and his team, and I'm sure you'll be pleased with the support that they provide. And Stuart, thanks, without interrupting again, thank you for putting this webinar on and for sponsoring it. I think that this is a service that is very needed, and certainly we appreciate the opportunity to to be involved, but we recognize the time and the commitment that putting these materials together and providing them at no cost to those people across the country is, and appreciate you for doing that.
Well, it's always a pleasure to be on and share your expertise with the market, Mike, and as you and everybody else knows by virtue of these things how much we appreciate your partnership. Thank you, everybody, for joining us today. As noted, you can download the presentation materials. If you have any follow-up questions that we didn't get to today or have additional insight and information you need, feel free to contact us, and we look forward to working with you and sharing more of our thoughts in the future. Thank you again, and we look forward to talking to you all soon. Thanks, Mike.
Thanks so much, Stuart. Bye-bye.